Hi class. In today's video, what we're doing is we're taking a look at accounts receivable and how they are initially recorded and how they are recorded during the life of that receivable in terms of what happens if there are sales discounts. So let's take a quick look. So sales discounts, basically, they're also called cash discounts. They occur when we want the accounts receivable to be collected quicker. So companies will offer you a little incentive. Often it's something like you'll get a 2% discount if you pay within 10 days. So basically it helps both the company that wants to collect the receivable, they'll collect them faster, and it helps the customer because they'll have less money that they owe. So it's a win-win. And so we see that the typical sales discount is written as a 210 net 30. Let's say that's a 2% discount if they pay within 10 days. All right, so when we get ready to record this, think about this. How does the company know whether the customer is going to take the discount or not? And should they record it at the amount assuming they take the discount or assuming they won't, or some mixture in between? So we've seen these terms before when we went through revenue recognition, and there are two approaches to recording the initial sale. We can use the most likely method or the expected value method. And the one we're going to focus on today is the most likely method. Okay, so let's take a look and see how this works out. Under the most likely method, basically the company is trying to figure out right from the get-go, what's more likely? Are they going to take the discount or not? Okay, so once we make that decision, then we have to deal with, okay, assuming we're right, okay, what's going to happen? And what if we're wrong? What if the other possibility ended up being the one that they chose? So we expected them to take the discount and they didn't. How do we deal with it? All right, so along with this most likely method, think about this. You can record the receivable at the net amount, assuming that the discount will be taken, or the gross amount, which basically is the full amount of accounts receivable, assuming that they're not going to take the discount. And so what I'm going to do now is walk you through the net and the gross method, and we'll look at them side by side, and we'll see how the accounting changes in the actual recording and how that affects our net sales. Okay, so we're going to look at an example from our homework to work through this. So what we have here is some information about a sale, and we're going to start by looking at it from the gross method way to do it. Okay, so we got hiking boots for $100 a pair. They sold 50 pairs, and the terms were 2% if you pay within 10 days, net 30. So, and it turns out the customer paid for 20 pairs of boots within the discount period and the other 30 pairs of boots after. Okay, so in the beginning, we assume that they're not going to take advantage of the sales discount. So we multiply the $100 per pair times 50 pairs, and we have accounts receivable and sales as 5,000. So this is the most likely method, assuming they're not going to take advantage of the discount. Well, lo and behold, on June 9th, they go ahead and they pay for some of the hiking boots. Okay, so what amount comes in? So remember, the initial was $100 per pair, and 20 pairs would be $2,000. So the accounts receivable for that part of the sale is $2,000. So we're going to write off the accounts receivable at $2,000. And what we're going to do for this other part is we're going to simply multiply the 2% discount times 2,000, and that'll give us a discount of $40. And then the cash coming in, of course, they don't have to pay that discount, right? And so the cash coming in is $1,960. Okay, what is this sales discount? This is a contra revenue account. Normally, revenue has a credit balance. This is a contra account, so it has a debit balance. All right, now let's see what happens for the other 30 pairs. Well, we don't have to do anything special. Basically, we simply take the cash, $100 times 30 pairs of boots. Cash comes in of $3,000. Accounts receivable is $3,000. So at the end of this transaction, we've collected all the money for all the pairs of boots, and as it turns out, the initial sale was $5,000. This sales discount is $40. Remember I said that's a contra revenue account. Our net sales from this is going to be 5,000 minus 40. That's our net sales from this transaction. So now we're going to look at it assuming its most likely method, but in this case we assume the customer is always going to take advantage of the sales discount. So our first journal entry goes ahead and takes the 2% discount. So this is called the net method. So you multiply the sales of 5,000 times the discount amount of 2%, and we go ahead and say, okay, our sales minus the discount would be 4,900, and we're pretty sure they're probably going to take advantage of that discount. We book the accounts receivable at the same amount, and so then we receive cash for the 20 pairs of boots, and so we go ahead and record. Again, it was you could look at this and take 2/5 of it, or just say, okay, 20 times 100 times 98% will give us the account receivable and cash amount. Okay, so they're only paying 98% of the actual sales price. The problem is that those other 30 pairs, they've waited to outside of the discount period, so they're going to have to pay us extra. Well, how are we going to book that? Accounts receivable is only going to be at the amount that's basically 98% of sales, but we're going to have cash coming in higher. So basically we show the cash coming in of the full amount, 3,000. The accounts receivable goes away, the remaining balance, and now again you could do 30 pairs times $100 times 98% will give you your accounts receivable. The difference there, you could call it a plug figure, but it's $60. It's also 2% times the 3,000 in sales. They call this sales discounts forfeited. Okay, so this one is got a credit balance just like revenue does. So let's see how this pulls out when we compare them in our little gross method to net method. So here we had our 5,000 less 40, 4,960 was our net sales. Sales, add the sales discounts forfeited, and so we end up with 4,960. Under both cases, we have the same amount of net revenue, or same amount of sales revenue. So it's just a matter of doing the adjusting, making the adjustment if they do or don't take the discount. Okay.